Tech selling off again today and dragging the S&P 500 and NASDAQ lower for a third straight day. Our next guest still sees a strong case to buy the dip. Let's bring in Fundstrat's Tom Lee. Tom, it's good to catch up with you here. Obviously, it's a bull market. Buying the dips generally tends to make sense. It's certainly been rewarded in the last several months. But it's almost like we haven't hardly had much of a dip to speak of. You know, you had these little wobbles lower, another one right now. Are you confident that they're going to stay so shallow?
That's a great question, Michael. I think one of the reasons these dips have been shallow is that measures of investor leverage, whether it's margin debt, which is still below July 2023 levels, or cash on the sidelines, which hit a record $6.1 trillion last week, or this past week, shows you that investors are still uncomfortably underinvested, and therefore these dips are opportunities to add. I've been traveling in Latin America for the past week, meeting with a lot of pension funds, and we're getting the sense that these investors are waiting for a dip. So as soon as you get some sort of wobble like today, I think these are quickly met by buying.
Yeah, I mean, it's certainly been the case, although how do you, I guess, jive that with the fact that you've seen some of the other indicators of positioning and investor sentiment, whether it's investment advisors or retail investors or call option volumes, seeming like at least things have gotten a little bit extended?
To an extent, those are extended because, prime brokerage data really tends to capture the TMT hedge fund positioning, which does look extended. And AAII tends to reflect bullish sentiment, but it doesn't necessarily reflect actual positioning, which, we can tell by margin debt still quite low. And other measures don't necessarily capture what private bank and wealthy individuals and households are doing, which, when we hear from our wealth managers, still have a very conservative bias for their clients. So I think that we're not really as exhausted in terms of positioning or even sentiment as we were in October 2021.
Now, I know, Tom, that you feel as if there's a potentially long-lasting outperformance cycle possible in smaller stocks. Been a lot of false starts in this direction. Been some pressure on the Russell 2000 and other small-cap measures with rates going higher. What sets the scene for you to say that small caps will start to work on a relative basis?
Well, it is a constellation of factors, Michael, that are really coming together for the first time. We're emerging from a pretty terrible inflation cycle that was, crushing for smaller companies, especially their ability to raise prices relative to larger companies. And it's coming at a time when the Fed is about to make a pretty abrupt move to being supportive of the business cycle instead of fighting inflation. And on a valuation side, small caps are trading at 44% of the price to book of large caps. That's exactly where we were in 1999, and that was the launch point for 12 years of outperformance. So I think when investors start to allocate to stocks and the Fed starts to be visibly cutting, I think the Fed is not clear when they start, but when they start, I think it's going to be a big tailwind for small caps.
Now, the relative valuation you mentioned going back to 1999 or thereabouts absolutely seems to be the case. The length of underperformance has been something similar. But if I look back at that period, after 2000, the peak in the market, a lot of that outperformance by small caps came because large cap growth just imploded. I mean, you just did see devastation in some of the largest stocks. Now, obviously, small caps held up better and then went up after the market low in the early 2000s. But I assume you're not suggesting that that's what we're in for.
That's right. I think one of the principal differences, is that it's the starting point. The S&P large cap is roughly 15 times X the Mag 7. The Russell 2000, if you look at the profitable companies there, have multiples more like 12 times. And the non-profitable small caps in the Russell actually have leverage either to economic growth or to risk premium declines. So you have like sort of the double recipe within the small cap index of quality companies having multiple expansion, but also sort of risk appetite growing and allows, whether it's the biotechs or some of the regional banks, which will have future growth, but actually don't really earn money right now.
All right. Yeah, we'll see if all that can coalesce. Tom, appreciate the time today. Thank you.